Is your CPG business taking off? You can easily check off the EDI capable box as you break into retail. SPS Commerce is your gateway to retail growth. With over 1 million existing trading connections and counting, you get instant access to the largest network of up-to-date, mapped EDI connections to retailers, distributors, 3PLs, brokers, and other supply chain partners without doing any of the heavy lifting yourself. With over 20 years of experience, SPS Commerce is the partner you can trust to get you up and running quickly and be there to scale with you as you grow. Plus, their team of experts is available 24/7 for support, ensuring you have everything you need. Visit spscommerce.com today to book a demo or learn more.
I would say exit multiples are helpful, or just showing some big exits, with big valuations is a good thing to show in a deck. And then I think a lot of times the deck is the hook to get into a deeper conversation that's more financial in nature. And I think if that kind of financial conversation can show, the kind of shorter term milestones you can hit with that funding, that I think is going to defend your valuation. I see the deck as kind of pulling someone in, but your model and conversations is getting them to actually write the check. The one other thing I would say founders should be cautious about is sometimes they include as comps companies that have raised a lot or a lot of money at some valuation, and they're sometimes unaware that those have actually been really bad returns to the investors. And if the investor you're showing that knows wait, all the investors lost a ton of money on the company you're showing as a reference point.
Welcome to the Startup CPG Podcast. Recently on our Slack channel, we had a super interesting topic come up around what kind of valuation could I defend as an early brand going out to raise. Now, I don't know a ton about the topic, but I do know enough to go ask somebody who does. So I roped in today's guest, Ryan Williams from FABID, which is the Food and Beverage Investment Database. He's been out there collecting data from all the transactions over the last few years. And so he can talk about what are the valuations like right now, who's getting that money, who's writing the checks, what are the benchmarks that you can use now, and then also from the previous few years. And he also gives some great advice for early brands that are raising. Hope you enjoyed today's discussion. I sure did. Hello, everyone. Welcome to today's show. I'm here with Ryan Williams. He's the founder of FABID, which is a financial services company known as the go-to source for CPG transaction information. Prior to FABID, Ryan led finance and operations. He was the CFO at RISE Brewing, which is a venture-backed coffee brand. Before that, he was an investment banker at Houlihan Lokey, which handles a lot of the transactions you've seen in CPG, like True Foods selling to Mars, a lot of stuff. So, Ryan, welcome to the podcast. Maybe you can just tell us all, how does somebody like you get interested in this CPG transaction space?
Well, first of all, thanks for having me, and pleasure to be here. How did I get interested in all of this? I got this advice when I was finishing up college to just pay attention to whatever you're, most curious about and go take a job in that, or what the most prestigious job is and go take that. So that's how I ended up, I think, on the finance side. And when I was there in my early days at Houlihan...
those can be different things, though. Most prestigious and things that are most interested. I don't know which is better advice, though.
The interesting side was one of the first transactions that I saw while I was at Houlihan was the sell side for pretzel crisps, which are those flat pretzels that everyone is familiar with. And so, I was there as, I think, an intern still. And after the kind of boardroom presentation was done, HR sent out an email to everyone in our nice Park Avenue office that all the bags of pretzel crisps that they had decked out the boardroom with as kind of a presentation bonus or whatever were up for grabs for all these people in this nice office that were making nice investment banking salaries. And I thought it was so cool just seeing 200 people stop what they were doing and diving into this boardroom and trying to grab, I think they had the special edition peppermint chocolate bark ones that were available around Christmas time. And I was that's cool. And then on top of that, the people that had started it seemed like they were obviously pretty happy. And I think that just totally drew me even more into the CPG and the financing side of it. And kind of sparked this question too of, this is awesome that all these people have made it to this kind of ultimate event for many CPG founders, which is the exit. But how have they gotten here? How they fund themselves before they made it to the boardroom? And I just kind of been curious about that for, I guess, ever since.
All right. It reminds me of my own journey where I was in management consulting and just doing this, like, honestly, very boring, like back office cost reduction type work. I think some consultants do much cooler work than I was doing, but I was like, what's the opposite of savings that no one cares about or will ever see? Like, oh, the stuff that they sell at 7-Eleven, that's fun. You can pick it up. It's exciting. And yeah, definitely. I mean, a lot of the work might be similar, but at least in CPG, it seemed much more tangible. Like you can touch the stuff. It's fun. So
absolutely.
Yeah, I relate to that. And then just the excitement of the new brands. So, okay. I wanted to chat with you today because sometimes there is just what I would say a banger of a thread in the Slack channel that I think is really interesting that everybody gets very excited about. And you were kind enough to weigh in on this one recently. So I wanted to just dig into it and then go deeper. So what somebody asked in the Slack, very common question, what are the valuation multiples for an early brand? Because I'm preparing a pitch deck for family offices. I think it's a great question. I also love to hear that they're going for family offices, given probably a lot of what we're about to talk about. So first, I just threw out my initial kind of amateur answer. I was like, well, I kind of remember in like 2019, basically what was going on is that I think brands had maybe like you could defend a 3 to 5 million valuation on day one. I don't know. People like CPG and entrepreneurship was still growing a lot then. And there were some exciting exits. And I think if you like had a good story and you were confident, you could go out there with that kind of a number and be like, oh, but it's like a safe or something. I don't know. Don't worry about it. Like it'll be fine. And their investors might be like, yeah, no, it's not about the valuation. It's do you believe in this brand or not? But then, maybe like later on we get into the pandemic, things like really tightened and then expanded again. And then I think at that point, people were just, it seemed to me much more consistent on the like 3 to 5x revenue valuation, which if you don't know what that is for somebody like me that didn't used to, you basically are just saying, what's the revenue you have for the last 12 months? Multiply that by 3 to 5x. And that would be the range. And if you're a very early brand, that's tough. So still, if you're a day one brand at that point, okay, you're not getting the 3 to 5, but it's going to be lower, but you'll have a story. So, now I think, man, it's tight. Like the VCs that I used to hear from, I don't hear from anymore. They're like not around writing checks. If they do write a check, they're like bragging to me or somebody about what kind of a ridiculously low valuation they got from the person, which honestly it makes me very unhappy to hear that from them. I'm like, okay, we're not friends anymore. And then like that's if they're writing the check, right? And so because of that, I think a lot of founders they've started looking other places. So, okay, first of all, what I really know is enough to tag you into the conversation. So,
appreciate that.
Yeah. What are you seeing? Because you gave a really awesome answer on the Slack thread, but what kind of valuations are you seeing for pre-revenue companies and low and high side of the range, and what would make you qualify for one of those sides of the range?
Perfect. So I would say, the earlier you are really at any stage, I think evaluation is having two parts. Like one is this kind of foundational, just for a founder and a concept alone to kind of put their time into getting something off the ground. Even if you have zero revenue, right? A company that has zero revenue isn't worth zero. There's some initial anchor value there. And then I almost think of like on top of that, as the company starts to grow, what do you add to the revenue component? Because if you had $50,000 in revenue, the company's not worth $150,000 or even $200,000. So I think decomposing it, like, what do we ascribe to this concept and the potential and the IP and the founders and all of that? And then what's almost the like financial component? And, as you grow there's kind of this like crossover that I would say happens as you get a little farther down the road, and you can look at it more purely as just the financial lens than this kind of I would call it like a foundation value.
Okay, so nobody's explained it to me quite that way, and I like this. So let me ask you a dumb question already, which is, okay, that anchor value, I'm like, okay, wait, so I just like have an idea and all of a sudden that has an anchor value that could be worth over $500K. Now, is that because like, no, it's a good idea. And so, yes, there's value to that. Not that I would like buy it from you, this idea at that amount, but like that as a business idea, if you're going to go for it, has value, or like there just has to be value for this to work as a business because, if you don't have capital, it's not going to happen. And so we're going to like give you a little bit of rope that there is value there. Or like, how exactly does that work?
I think it's both. Like, I think, as you said, you can't, if you watch a Shark Tank episode where Kevin talks about like cash flow valuations for a company that's just started, it's like a nonsensical position because that's irrelevant to something that's so early. I think there's a lot of factors and it's holistic into what that number is. So I think, some of the major ones that if I was in the investor chair, I would be thinking about, and I think a lot of investors are first of all, what's kind of the immediate growth potential of this? Who are the people that are starting it? Have they sold a company before? Do we, feel like the brand is really well defined and is going to have great traction? So all of those things, whether you can quantify them as, there's some companies before they even launch, they have maybe a relationship with a major retailer that's going to put them on shelves. So I think if you can quantify, what the kind of initial growth curve looks like, what the market opportunity is, and get buy-in that there's, long-term, ultimately an exit value to this concept, and you're the person to make it happen, that I think influences this, whatever we want to call it, foundation value. And what I've seen is, let's just kind of take like an anecdotal median. I think the anecdotal median of the median CPG startup, which of course no founder thinks they're the median, but there is a median in any cohort. I think, 3 years ago or at the peak of the market, that median was probably 5 million. And I would say now it's probably 2.5. Just as like, I've got an idea on paper and some good people and a concept here, because I think a thesis on the investor side is we can't own so much of this company so early that the founder is no longer incentivized. And, that opens a separate conversation of why sometimes, even though they've produced in some cases good companies, some of the kind of, venture studios have run into issues because they have such an outsized portion of equity from day one that when the company grows, the founder doesn't necessarily have enough to to kind of retain the incentives that they would in another case. So, that's kind of how I think about it.
Okay, so then from the investor standpoint, because I've talked to a fair number of early stage investors. At one point, we were like, oh, maybe we could do a startup CPG fund, something like that. When I talked to a bunch of them, they're like, look, it doesn't make a lot of sense investing at the very early stage because the chance of success is quite low. So, you're saying, before they would want to leave you with enough of the company that you would still be able to raise money later and have an attractive exit for yourself to keep going. But now it's almost like they're like, we better have a bigger stake at this company if we're going to invest in it so that it can be worth something and have it kind of make sense. So if in general, that's pretty tough for brands and it's pretty tough for investors. I mean, it tells me that, I sort of like this person's question about going to family offices and like angel investors who, a lot of times they're investing because it's fun for them, or they're passionate about like a category or a cause or the founder and want to help them.
Absolutely.
And, it's kind of lets everybody try, maybe, milk their network, I would say a little bit, and try to find some of their own personal champions who probably can't be as helpful to an early brand, but aren't going to give you as hard of a time, and giving you a good valuation is being helpful.
Absolutely. Well, I'll say a couple things because I know it's always fun when there's a little bit of a back and forth on a topic, because I've seen both sides. I think that the downward trend in valuations is probably like a long-term positive thing, because it's going to allow those investors to have a good return. And there's a ton of people out there that have stopped investing because they've had terrible returns. And so I think to get more capital like flowing back into the ecosystem, and as we kind of go through a cycle, it's a really difficult position for all the founders right now. I think I like empathize with every one of them and try to help all of them. But on the other side of the coin, to get money flowing into the system, there has to be exits again. And there has to be exits that make the early angel backers a return, unless it's just purely altruistic. And I think, the ratio of kind of capital invested and the valuations that came in has made it so that almost every angel I know has taken a bath on their angel investing. So, it's kind of this catch-22 of like, I think CPG is a nice industry by default, and the people are certainly nicer than the average person in investment banking. But I think also to re-spark investment, there needs to be a reset in the equilibrium, which has kind of been, I think, overcorrected, and that's unfair. But I think we're kind of getting back to what makes sense.
Okay, and so again, just to understand the why here, because like there are exits happening, and I think I don't have the most recent data, but if I think about what's out there on sell-through data, like I think in general, overall store is up, categories are up, pricing obviously with inflation and everything is up. I think profits for big CPG companies are up, which probably helps them do more acquisitions if they want to. So like people are making money out there, but it doesn't mean that the early stage investments have really paid off. And obviously, when the interest rates are so high, it's like just money is not as readily available out there. So there's just like less of that money flowing around. So I know I've read your most recent report, and I know, one thing that you call out there is, it's not just that the valuations are low, it's just that the overall money going out there is pretty low as well, right?
Absolutely. Yeah. So like it's fallen by more or less 50% in aggregate. So if you look at the investment into food and beverage across stages, it's down more or less 50%. And this most recent quarter was one of the lowest in the past 10. I think it was a little shy of 300 million. And then the majority of that is kind of disproportionately going to companies that are, let's call it semi-established, like Series A, and then established, like post-Series A. So of that 300 million, or of whatever we track in each quarter, maybe 15% of it is going to the early stage, meaning in a given year, at kind of the pre-seed, seed, like seed plus stage, which I would say is companies kind of sub 5 million in revenue. There's probably 150 or 200, maybe 200 million. And then there's probably some money that like isn't public and we can't find or track. So maybe it's a little more than that, 250, right? And I think like the biggest thing for founders to remember, or one of the biggest things, is you may have a good brand that's investable and you're a great founder, but just think of yourself in a competitive market where your deck and your data and is right next to 10 other great people with 10 other great brands with 10 other great products. And so you're ultimately competing with kind of the marketplace. And I think that obviously sets valuation. And if you need money, I think I would work backwards from, let me see who's willing to give me the cash I need as a first question, as opposed to starting with, this is my valuation and holding to it, which I think can actually harm you in both ways. Because if you're not profitable, your cash balance is dwindling, you've gone to more people, maybe you can't afford the launch that you wanted or the marketing program you needed. And now 6 months have gone by and you've anchored to whatever valuation you picked, and you're in a worse position than when you started. So I think when there's a, let's call it like a brand favored market, which there was in 2021, the VCs were kind of price takers and had to pay up to get deals. Now that dynamic is inverted and the brands are price takers, and I just think that's kind of the equilibrium that I find very interesting.
Yeah.
We'll be right back.
Are you paying a ton in shipping to send out products, samples, and whatever else? The fees really add up, but lucky for you, we now have a partner that gets you access to the discounted shipping rates that are usually only available to those big companies. I worked with them for my last beverage brand, and I can tell you they definitely got us savings. Whether you're sending overnight samples, fulfilling e-commerce orders, or even a 40-foot ocean container, our partner, Enterprise Purchasing Group, or EPG, has got you covered. There are a bunch of free benefits you can get by signing up with them. You can get up to an 86% discount on small parcel shipments from UPS, DHL Express, UPS, and more. You get really competitive LTL and FTL rates through UPS. You get discounted spot and fixed ocean rates through Flexport and Maersk. You get exclusive air freights, and you also get preferential terms with supply chain financing. All you need to do is reach out to Francis Agas. His email is francis, Francis, at enterprisepurchasing.com. Mention the Startup CPG discount and take advantage of those savings. Good luck, everybody, and happy shipping. And now, back to the show. You know, one interesting thing is, starting about, I don't know, a year and a half ago, like the hottest thing to say would be like focus on profitability. And you would hear every VC talk about that kind of as if like they thought they were like the first people to ever say that to anyone. They're like, so what you need to do, hey, wait for it, is focus on building a profitable business. Like, I understand why they would love to have that be true in everything that they invest in. But I don't know, for me, like having started a brand, having been at tons of early brands, like, yeah, sometimes you don't do that and you flame out. And a lot of brands have done that very famously. But I also think like, man, you also do have to grow to be an appealing brand. I would almost approach it more if I were an early brand as like, okay, if I can raise money, like this is the amount of money I have to get to go to where I need to be. Not like, oh, I need to be unit profitable like day one when I sell one unit. Because it's just not realistic. You got to do 100%. Like trial runs. You got to build a brand and be able to invest in marketing and all that stuff. So I don't know. I feel under-equipped to really be like the only person on that side of the argument, but I feel like you might have some insight into it.
Well, I've tried to take the position too of like focusing on just our data and analytics for our marketing of thought leadership. But I agree with you on that. And I would say like, I think sometimes there's a lost in translation of focus on profitability with a be profitable. And I think some companies were blind to profitability for a while. And I think certainly like that no longer is allowed or, going to get you funded. But the question is, maybe how unprofitable can you be, or how much cash can you be burning relative to your growth? And I think, one of the clearest cut ways I've heard an investor, say they kind of like quick ratio a brand they're looking at investing in is how much capital is this brand raised relative to the trailing revenue they've achieved. And, maybe if you've raised recently, you can kind of subtract that. But basically, how much cash have you burned and how big have you gotten with it? And I think if you can keep a ratio of 2 to 1 for a while, you're not in like that bad of a position. Maybe that's ideally
2 to 1 for how much you raised to what the revenue was.
Other way around, like your revenue to your, and maybe you should really be at 3 to 1, or maybe that standard has gone up. So meaning,
so if you can get to 10 million in revenue, only raising 5 million, you're going to look good on that metric.
Correct, and even better if you get to 10 million using 2.5 million. So I think like it doesn't. I mean, also like it makes a lot of sense to founders that this is where I think they're absolutely right. Is they're like, you're telling me I need to be profitable, or you'll come back to me when I'm cash flow positive or break even. And it's like, I wouldn't be talking to you.
Yeah. What do I need from you at that point, buddy?
Right. Like,
well, you're not writing checks anyways anymore. Yeah.
Right. Yeah. So I think a greater emphasis on profitability is positive. I think there's also outlier examples of companies that everyone kind of anecdotally knows are wildly unprofitable, but have also had wildly crazy growth. And, the verdict is out on whether that was a good approach. We'll see. Do they get an exit, and does it make their investors, get a good return?
Yeah. Yeah. I mean, we've seen it go badly, right? For plenty of them that, just had no focus on it and just going for growth. And maybe they were part of a fad that has since subsided. But then we've also seen some companies just get on that raising trajectory, raise, build revenues, and then sell to somebody who can then bring their cost down to like a fraction of what it was. Like, if they get bought by a big CPG. that has better manufacturing. So pretty interesting. But so at the same time, it's also true that, there are still transactions and people raising, but at least from my perspective, it's like more of sure thing kind of investments where you look at it, or maybe the investors feel that way. They're like, yeah, once something is really proven, like there are people getting money, but it's ones where they're like, yeah, they feel like they can really see their way to the end. Maybe they're not taking, as much of a leap of faith. What do you think?
I think there's been a pull towards, funds moving towards companies that are a little bit more, farther along and more likely to exit. I think there's probably like a hidden dynamic there as well, which is it's really difficult to operate a subscale venture fund, the 10 or 20 or $30 million venture fund. If you look at the fee structure for a typical fund, the fees are 2 and 20. So 2% on a $20 million fund, you have $400,000 a year to pay all your legal bills, your own salary, your travel expenses, etc. I'm not downplaying $400,000, but by the time you pay for all your, fund infrastructure and salary and an analyst, you're kind of an entrepreneur too, running a $20 million fund. And so what happens is, if you run a successful $20 million fund, in order to kind of have more available kind of ongoing operating cash available, you raise a $50 or $100 million fund. And so what's happened is like the smaller funds that were backing smaller brands, if they haven't had great success, haven't been able to raise the next fund, and so they've exited or kind of aren't actively investing. And the ones that have had success have gone out and raised a fund that's twice as large or 3 times as large. And when you have a larger fund, you're deploying larger checks into larger companies. And so it creates this kind of, gulf, at the early stage. And again, it's another kind of reset that's happening, and it's going to take a while.
Yeah, I guess I wonder then also, because of the environment, then even like, let's say a small fund makes a good bet on a brand, but still just like probably the time to some kind of an exit now is extended even. So even if it is a good bet, they still don't have that money probably, which means they haven't locked in the return, which means they're having trouble raising their next fund. But yeah, I don't know. And it also just makes me remember something like 2 years ago, it feels like, where some of the big funds, even that were doing kind of mid-sized investments, like let's say Power Plant, that was investing in a bunch of companies, then like funds like theirs were actually going much bigger. They're like investing later stage, like, oh no, once it's like a sure thing. Like I remember, Oatly, like, had this huge investment, I think from BlackRock. Blackstone. Sorry. Thank you. Right before they went public, like, okay, sure thing. Boom. Throw all the money in public. Great return. It was sort of like that model, but a little bit earlier of like, they're definitely going to make it. Money, boom, turn. Like, okay. And that was like a good model for a lot of them. But, they like rebranded from PowerPoint to Ground Force. And I think a bunch of others did kind of a similar game. They're like, we're just going to invest in later ones that like, we just put the money in, flip it, like good to go. So all of that taking money away from a bunch of the early brands. So I guess one question that I'd have for you then is, what would you be telling an early brand maybe that doesn't have the like Insta network of like Dial for Dollars? Like, do you like that angel and friends and family route? What do you think about some of these financing options that are out there? What are you telling people?
So I think at the earlier stage, and this, I think probably leads into other questions you may have around like networks and those kinds of things that some founders have more of and some founders don't. But I think in general, I think like CPG angels are a very difficult and shrunken audience to raise from. And first of all, the excitement that I think everyone that works in CPG has about creating brands and products and how cool that is. I think people in other industries, real estate, media, tech, the list goes on, are maybe not as like jaded with some of the, with the last couple of years, and have been generally speaking much more apt to, to back new founders. And so I would say like, I joke with people, like if I was starting a brand and I needed to raise money for it, Like, I honestly think I would just like post myself up at like a Four Seasons bar every night, as opposed to like, which is not to say you shouldn't also go to startup CPG events. Like, you got to do everything. But I think like a lot of the people, and we do the finance and accounting for a growing number of brands, and I look at the cap tables, and the early people on the cap tables are like, what did that guy do? Oh, he has like a, or that woman, she has a whatever, like a business is just totally unrelated. So
I like that. Oh, that's super interesting to me. It's all, and even like, I think a lot of brands who are, serious about it, were like, no, let's go after tech investors because they're not going to give us that hard time. They're going to give us like, tech multiples, and they're like, we'll get a much better valuation from them. But, at the individual investor level, I like that idea of just like, man, get out there and just talk to a lot of people. And it's almost like, I think like in my 20s, I would have, if I had some extra cash, I would have like loved to put it into a bar. Like if a friend had a bar, like, oh, that'd be cool. I'll do that. 100%. Or a restaurant, I'll like be cool and I'll have a table there, or I'll be cool at the bar and be like, oh, me? Like, no, I'm a part investor in the, I feel like CPG is the new investing in your friend's bar. Like, be like, oh, no, because CPG is so cool now. Like when I went to business school, I graduated in 2009. In those days, I would say, I don't know, something like 80% of my class went into something very traditional, finance, consulting, like, banking or hedge funds, like very, very typical. Some people who were like, I don't know, had like really well prepared and had cool jobs before could go into PE or VC. And then some people went into CPG in general, like brand manager or General Mills. That's what they were doing. And I had like two friends maybe who went to a CPG, start their own thing. They definitely weren't going, like, I don't know. One of them went to Bonobos and was an early employee there, and that worked out great for him. But we were like, what are you doing, dude? That is weird. And now everyone would be like, how'd you get that? That's like the equivalent of the people our year who got the McKinsey internships. Like, whoa, how'd you get that awesome job at a CPG? And so many of them just go and start their own CPG startup despite the opportunity cost that they have of like being able to go and earn a big salary somewhere else. So it is just cool now, like CPG, like starting these products because of all the, I think, celebrities and public successes. So I love that approach. And I almost feel like we could start a reality TV show of like, okay, take all the founders, like put them at the bar, at different ends of the bar, and see who can like get a check first.
Well, I'd sign up. That sounds fun.
All right. If it's a tropical Four Seasons, maybe, then just for all of our benefit. So, okay, on a more serious note then, tell me a little bit about the access to capital, which is already difficult for minority founders, for female founders, because I think what we all have heard is this awful number that like 2% of VC funding goes to women. And from what I've seen, it's not getting better. Maybe it's getting worse, like it ticked up and then it ticked back down. I think for founders of color, I actually don't know the number. I think it might be even worse. And so, like, do you see any of that on the data side, or like, is it something that you're hearing about from any of the players in the industry about, like, are they taking any concrete steps?
Yeah. So, first of all, we tracked it a year or 2 years ago, and it is like relative to the demographics of our country, like there's totally a disproportionate, level of capital, I guess, doesn't go to people of color or women. I haven't tracked it enough to be able to give an update on our kind of initial numbers, but I think no one would question that. And I can say this just with total certainty that, it doesn't match our country as kind of holistically. It has
not jumped to 50%, is what you're saying.
It has not jumped to 50% or whatever kind of like mapping you apply. And I think I think there have been like a number of funds that have made that a dedicated kind of focus. I think it just continues to be area that's challenging for a lot of people. Just anyone that doesn't have a network, I think it's just extremely difficult. And if you do, just gives you this starting advantage of capital, or even talking about like a friends and family round. The hardest dollars are kind of when you just have an idea on paper. And I'm proud to have personally made some angel investments of people that are from diverse backgrounds. But I think I think it's an important conversation and, an area where, it's, yeah.
Yeah, I know it's tough to get the data in these kind of areas. And I think that is one of the most important things is to track it, because if you don't, then it just kind of is like a dirty secret in the industry that nobody really acknowledges. I think that like that 2% number for me is so powerful, just at least to start the awareness, which I think is a good first step. So anyway, open offer, if you ever really start tracking it and maybe even like showing which funds are at least making the best like movement in the right direction, we will report on that and share it with everybody.
Well, and I've seen like Crunchbase has made like a pretty concerted effort there. Maybe not with the same quality in food and beverage, but kind of the headline statistics are the headline statistics, and so I think those are super relevant. And PitchBook has also like I think done a good job. But I would love to, in a year or so have the resources to track all that stuff ourselves. And I think it's an important thing for everyone to be trying to address.
Yeah, awesome. Okay, well, we'll stay in touch on that. And by the way, how do you sort, like, you know about all the deals, how do you source most of the info? Is it coming from like Crunchbase and you're just doing a better job of organizing it, or you're getting all the sources out there and putting them together? Just tell me the secret sauce.
We're the primary source. So we don't like look at or reference any other data aggregator. So we have our own. I'm not one of these people that's like, we've got some AI technology, but we have some basic technology that has some, lines of code that track, government databases that basically report or have some portion of funding data. And then on top of that, there's all the different news sources, whether it's the Startup CPG newsletter or BevNet, all of their, a lot of times BevNet or Nosh will have an article of something that's non-public. So, we add that. And then people tell me things. So, you can always tell me like under the radar news. Yeah. I think it's pretty obvious to me at this point, like what's what I would call like a open secret and a closed secret. So if it's an open kind of like, oh yeah, we know that company raised like $30 million last month. That'll go on our database. And then we just, it's just a ton of tedium over a very long time that we finally have a process around, and in aggregate, we can report on it.
We'll be right back. Hola, amigos. About 4 years ago, I got a message from a designer in Colombia who said she'd like to work with Startup CPG to build her reputation in the US. I couldn't believe how affordable her pricing was, and the quality looked top-notch. I started work with them for Startup CPG and then a bunch of my other CPG projects as well. Fast forward to today, they are the most beloved agency in our Startup CPG community. They've got dozens of happy customers like Prickly and so many more. I recommend them to absolutely anybody who will listen, because the combo of top-notch quality and very reasonable pricing is exactly what you want as a startup brand. You can hire them for branding, packaging, your website, or they actually have an awesome startup package that will do all three. If you want to learn more, email them at startupcpg@wagondesignstudio.com or check the show notes. You could also post on our Slack for feedback and just be overwhelmed by how many people want to sing their praises. Gracias, Wagon! And now, back to the show. All right. I wonder, maybe we could just do a quick like roundup of a couple raises that you're psyched about that you've seen in the past couple quarters. So any, CPG brands that you think are relevant for people out there in the community that we'd love to hear of. Are you able to just kind of rattle off a couple and just whatever you can remember about some of the details?
Yeah. Let's see. I mean, the biggest one of the last quarter was Voyage Foods, which I'm not commenting on the, I don't know them. I don't know their investors, but it was the biggest headline number, of Q2. I think it was interesting because they had kind of this AI angle to their product development. And I think that's kind of interesting with how big AI is in every context, like maybe something to think about for founders of that seems to, not hurt, from a fundraising perspective. The recent
you never know how much of that is horseshit, by the way. I don't know anything about them, but like, I know at least in like the whole industry and food tech, like, bro, that's a recipe. I'm not saying about them, but I know there are some companies where they're like, here's like somebody pitched me on something where they're like, look at this amazing it's a proprietary technology that was developed with robots from this other planet that, had like, born of AI. And I'm like, no, that's a recipe. Like, I've seen this recipe before. I know what's going on here.
Yeah. I mean, there's like cool stuff I've heard about, like I think Notco and AI and putting pineapple juice in their milk product to make it taste more like, I think some of it's, anyway, I'm not taking a stance one way or another. I think, unfortunately, once you become like a banker and a service provider, you're just cast more into this like gulf of neutrality. Yeah, another, I think, more interesting one is Athletic Brewing and their $50 million recent raise from General Atlantic. I think it's interesting in that, like, when you look at the current market size and the market share of Athletic relative to the valuation there, which I think was 800 million, or at least that was reported, you have to believe like a pretty significant increase in revenue in a short period of time to underwrite that valuation. So there's an interesting kind of discussion about it on I think his name is Anson Friedrichs, who has a fund called Athletic Capital, just of like, would I have made this investment or not? So yeah, I thought that was interesting.
Okay. Any like early stage ones, kind of the smaller level, like, oh, good for them, they picked that up.
Yeah. I think this is public. AO Foods I've seen, which I don't know if they've launched, but I think has a really interesting product coming out and some great investors behind them. Not Beer, which I think like caught a lot of attention. I think it's like a super cool looking brand, and I know Dylan, he's a good founder. I think there's anytime there's like anything generates chatter of like, is this like a follower concept, or is it like, is there room for two? I think that's like a fun kind of conversation.
Do you remember what any of these like early sizes or valuations, if those are public, are getting done at?
Yeah, in general, like the early ones that I've seen, I won't ascribe a number to anyone specifically, but I've seen a lot of things as much as like 11 million for something that was in, I would call it more like the not food and beverage, but like something you'd see in CVS, like the ointment space, with like a patent around its ointment and so forth. So I've seen like on the very high side, let's call it 10 million pre-revenue, and on the low side, like 2 or maybe 1.5.
Okay, so Ryan, maybe from your database, can you just read out some of the interesting early stage raises and valuations, like stuff that's just come across your wire lately, to give people some benchmarks?
Absolutely. I won't even read them out. I'll make you think I'm like Rain Man that just like remembers every transaction, and every date. I think some that come to mind, like off the kind of top of my head, are Sauce, which was pretty recent. I've tried the product. Like I think they're really good, and obviously kind of I think is attached to the recent Rayo's acquisition by Campbell's, and pasta being like a huge category. And I just think they've managed to make something like cool and differentiated and good tasting in a huge category with kind of a brand identity of its own. And so they've been fortunate to secure some funding like very early for that. So I thought that was cool. Haywell, which is in the kind of better for you, I would call it like gender neutral, meaning like not Monster with like a fingers ripping the can open branding of energy drinks from Brit and Doherty. They raised in the second quarter. The product, first of all, it tastes fantastic. It looks great, and it was every retailer that I've seen it in, I always just kind of do my anecdotal like, are people buying this? Like and that sounds like it's going very well in the places I've asked about. Another one, like just getting started, that raised, I think like a $4 million round out of the gate, called Key, that received some funding from Ag Funder, and I think a few other, venture firms. And their focus is going to be on like ketone, beverages. The founders both come from, I think, Coke or some like a large, big CPG experience. I think, Dylan and Not Beer, which I think caught like a lot of, the Twitter universe by storm. So I think there's deals that are like definitely happening at the very early stage in food as well as in beverage. And
that the Not Beer one was funny. I don't know him. I've seen the brand. I think just everybody started talking about it for 1 or 2 weeks. It was just like evidence of the trend, and here it is, and it's not beer. I think because it was like so on the nose that people really liked it. You know, And it was, people were definitely excited about that. And I see them growing and like hiring up, and looks like they're gonna go for it, which is great.
It was definitely cheeky, and like it takes it's one thing to like come up with an idea and like kind of be able to joke about it with your friends, and then to go for it is, I think, it takes another a level of conviction. And for the people that are like, oh, this is silly and this is the following concept of liquid death, and are kind of like maybe poking at, I respect anyone that like goes for it in CPG. Like, I haven't done that.
You know what I like about Not Beer, I think the most is that, so if I have a party, I lived in LA up until a couple weeks ago, and I would have parties a lot of the time. And it was mind blowing to me that half of the people at my parties, like fun social gatherings, could be on a Friday night, with a Saturday daytime, who knows? Half the people were not drinking. And I would be stalked for this because I know they're going to come in and they're going to, like, some might want a mocktail if I have something like that. Some might want a sparkling water. I don't know. So Liquid Death obviously did extremely well in that space. Like, I mean, I don't know exactly what percentage of people drinking it just drink it because they want some water during the day, or what percent are drinking it to like avoid alcohol. Probably it's a smaller percentage, but it's, still some percentage in there. The thing that I kind of like about Not Beer is imagining having that at a party. And like, I think not only does it let you then have a nice non-alc option at the party, but it also lets you be a little bit snooty to the people who are drinking. They're like, what's that you're having? Well, it's not beer. Like, specifically, like, what are you having? Beer? Yeah, this is not beer. Just, you can sort of like poke at them with it also. So it's like a night you can, if you identify with that, then maybe that's a choice that you would like to have at a party, a way to, really share your values in a way that's a little bit in the face of the people who don't share them.
Definitely. I would pick up a can myself, and I would say, like, Mike Cesario reached out to me because I had written some Medium articles like 5 years ago before he launched Liquid Death. And I will say this, the things that have been most kind of like, I don't get that, or that's weird, or like that makes no sense, or whatever, have been almost exclusively the ones that have become incredibly successful. I mean, I'll give another example of that. I worked on a consulting project in kind of the background for Kali Power when it was first starting out. And I just remember thinking, like, this is crazy. And who is going to, in their right mind, buy like pizza with cauliflower in the crust? Like, that doesn't even sound good. And, I think they're at 100 million in sales now. I've probably contributed 1 million of it. And I think, like, if an idea strikes you as like this is a bad idea, there's this fantastic Venn diagram from the tech world from Chris Dixon, who's I think an investor now at Andreessen Horowitz, and he has this kind of like Venn diagram crossover, and it's like good ideas and bad ideas, and the intersection is like good ideas that look like bad ideas. And that's like kind of the business that startups are in, is identifying something that everyone else didn't pursue and doesn't think is worth pursuing, but actually should be pursued. And if you're building something for venture, like, you're taking kind of that bet that you're in that middle overlap, and it just takes time to find out if your thesis is true or not.
Any brands that come to mind you that could be in that Venn diagram right now? I'll throw out one. I hope they take this as a compliment, because they should. But like, if the brand Holy Water, that I feel like everyone's seen it. You don't know why, but you've seen it. And I think I've heard buyers talk about it, and some are like, I really like this, and others are like, I don't get what this is. And I'm like, yeah. And then I think I gave that feedback to the team, like, oh, I just want to, I like to pass along buyer feedback. Like, oh, hey, just like, one of them said, and they're like, yeah, we know. Like, it's cool.
Yeah.
I feel like, oh, they probably do have something there if they're getting that kind of reaction from people. That's exciting.
I think like Mom Water also, coincidentally fits into that. I've seen their numbers; they're pretty impressive. I'm friends with Spencer Hodgson from Gay Water, which I also think is a brilliant idea, and kind of like has this kind of initial reaction from some people that is like, it's too edgy or something. I think it just makes a ton of fundamental sense. I think in general, like if a portion of people don't react to you with a like, I don't get this at all, then, I don't think you should try to be intentionally controversial or polarizing or whatever. Like, I don't think that's a strategy. But if you don't have an idea that grabs attention, how are you gonna get people to pick you off the shelf? So I like a lot of those things. And if I was starting a fund, that would be one of the questions I would ask is like, do a lot of people think this is brilliant, and do a lot of people think this is ridiculous, which is what they said about liquid death as well. And if there's two camps of people I respect that both have like extreme reactions, I think that's a good thing, not a bad thing.
I love it. All right. Well, let's all be ridiculous on that note. And so I think that's a good place to end those inspirational words. Ryan, thank you very much for bringing this wealth of knowledge here to the Startup CPG podcast. And I'll plug Spencer also from Gay Water, who was on the podcast with us a few months back. Man, he's a pro. I loved that episode. I think, you can definitely have that kind of an idea. And then if you're also a really strong founder who knows their stuff, look out. So very excited to follow along with that brand and a bunch of the other ones that you mentioned here. So I think for anybody who wants to follow along with Ryan, probably, what do you think? LinkedIn, a good place to do that and keep seeing reports and everything?
LinkedIn, our business is accounting and finance, if anyone ever needs help with that. And my email is ryan@thefabid.com. I try to reply to everyone.
Back when you were talking about like wanting to sound like a savant, I was like, maybe the FABID is just his brain. And like, oh, would you like some data? Like, blink, blink, processing. Here you go. 4.2 million was raised in that would, I'm just going to start spreading that rumor if that's okay.
Please do.
All right. Ryan, thank you very much. Thanks everybody. I hope you got some good, useful nuggets out of this. And actually, you know what? I have one more question before I end. I just thought of it and I don't want to end without asking this. Okay. If you are now a brand raising and you're trying to defend your multiple in a deck, let's say, what are you going to do right now? Would you like just be kind of Googling similar companies and trying to see how much they actually raised at and put that into your deck, or at least have that stuff internally? Like, okay, ideally somebody can just take the numbers that we just used and use those as some good benchmarks. But if they need more benchmarks, how can you actually get them as Crunchbase? Or, maybe they don't have access to the FABID or...
Yeah, I would say exit multiples are helpful, or just showing some big exits, with big valuations is a good thing to show in a deck. And then I think a lot of times the deck is the hook to get into a deeper conversation that's more financial in nature. And I think if that kind of financial conversation can show, the kind of shorter term milestones you can hit with that funding, that I think is going to defend your valuation. I see the deck as kind of pulling someone in, but your model and conversations is getting them to actually write the check. The one other thing I would say founders should be cautious about is sometimes they include as comps companies that have raised a lot or a lot of money at some valuation, and they're sometimes unaware that those have actually been really bad returns to the investors. And if the investor you're showing that knows wait, all the investors lost a ton of money on the company you're showing as a reference point.
Don't you want to be like that?
Be cautious of putting other unexited companies as your reference point, because you might include someone that is a negative reference point.
That's like when somebody reaches out to you on LinkedIn, hi, I see you're connected with so-and-so. Wouldn't you like to have a call? You're like, I hate that person. They really screwed me over.
Exactly.
Why did you bring them up?
Exactly.
All right. Yeah. All right. I'm really done this time. Ryan, thank you so much. Hope everybody enjoyed. Catch you next time. All right, everybody. Thank you so much for listening. If you enjoyed the podcast today, it would really help us out if you can leave a 5-star review on Apple Podcasts or Spotify. I am Daniel Scharff. I'm the host and founder of Startup CPG. please feel free to reach out or add me on LinkedIn. If you're a potential sponsor that would like to appear on the podcast, please email partnerships@startupcpg.com. And reminder to all of you out there, we would love to have you join the community. You can sign up at our website, startupcpg.com, to learn about our webinars, events, and Slack channel. If you enjoyed today's music, you can check out my band. It's the Super Fantastics on Spotify Music. On behalf of the entire Startup CPG team, thank you so much for listening and your support. See you next time.